silver suddenly dropped nearly 3.5% in a single, remarkable move, and the rapidity of that reaction holds more significance than the absolute size itself. Markets usually don't sell silver excessively without an underlying cause, and this decline was definitely not fueled by panic or an immediate breakdown of long-term, fundamental factors. Instead, it was triggered by a combination of financial conditions tightening all at once. As the US dollar strengthened and bond yields accelerated higher, silver unfortunately found itself on the wrong side of a notable macro shift that investors have been closely observing. In the financial markets, silver is more than just a basic metal. It's indeed a rate-sensitive asset. When real yields are on the rise and safe, assets like cash start offering enticing returns again. Assets like silver immediately face pressure. This exactly was the case here. Stronger economic data and persistent inflation fears significantly reinforced expectations that rates may potentially stay higher for an extended period, and therefore the market adjusted swiftly to those changes. Simultaneously, the presence of speculative positioning in silver had become increasingly overwhelming after a recent uptick in recent weeks, leaving the prices vulnerable to a quick reset once momentum wanes. This is precisely how financial markets function. When positioning and market dynamics come together, sharp price moves can unfold quite rapidly without there having to be dramatic news. The main point, however, is that this drop represents a reaction to broader macro signals, rather than a sudden rejection of silver's essential role as a hedge. Markets are constantly reassessing risk in a high-yield environment, and silver is responding to that reassessment. Understanding the reasons behind this move can help investors better dissect short-term pressure from long-term relevance. Hence, maintaining that crucial distinction is of paramount importance as financial conditions continue to evolve and transform. What made this move more pronounced is how multiple financial forces converged at the same time, amplifying what might otherwise have been a modest pullback. Bond markets played a central role. As Treasury yields moved higher across the curve, the opportunity cost of holding silver increased immediately. In periods where yields rise quickly, silver tends to react fast because it competes directly with interest-bearing assets. Investors don't need to abandon silver entirely for prices to fall. They only need to rebalance toward assets that suddenly offer better short-term returns with lower volatility. At the same time, the US dollar strengthened, adding another layer of pressure. A stronger dollar mechanically weighs on dollar-priced commodities, but more importantly, it tightens global financial conditions. When the dollar rises, liquidity outside the US becomes more constrained. Speculative demand cools, and metals often suffer first. There was also a positioning element at work. Recent optimism around silver had built up leverage and short-term expectations, particularly among traders looking for a quick continuation higher. When price failed to hold key levels, those positions were unwound rapidly, turning selling into acceleration rather than gradual decline. This doesn't signal a loss of confidence in silver's long-term narrative. It signals that markets are enforcing discipline in a high-rate world. In this environment, assets don't move purely on stories. They move on funding costs, currency strength, and positioning. The 3.5% drop reflects how sensitive silver remains to these variables, especially when markets are recalibrating expectations around inflation, growth, and how long restrictive policy may persist. Another crucial layer underlying this market reaction is how investor psychology undergoes a transformation when markets move from anticipation to confirmation. For several weeks, the price of silver had been trading primarily on the basis of existing expectations. Expectations that inflation would persistently cool, that rate cuts would move closer, and that financial conditions would eventually become more relaxed. These expectations supported the ongoing movement of silver, even when hard data failed to fully confirm them. However, the problem lies in that markets can only sustain these expectations for a limited period depending on how long their underlying foundation remains intact. When incoming data or market indications suggest that those expectations could potentially be delayed or revised, the repricing process quickly ensues. That's exactly what happened to silver during this particular period. For instance, as yields in the US dollar gradually rose, the markets were compelled to reflect on the possibility of policies possibly remaining restrictive for an extended period, a scenario that many investors had not initially anticipated. In this dynamic moment where investors find themselves forced to confront this possibility, silver behaved in a way that fundamentally shifted its purpose from a long-term hedge to becoming a short-term trade investment. This distinction proves to be significant. Long-term silver holders' actions might not be noticeable, but short-term investors quickly recognize any opportunity and capitalize on it. And it's these small yet critical inflows that drive significant daily price movement. In addition to this, there is also a broader cross-currency dynamic at play. When equities show resilience and other risk assets remain supported, investors tend to be less encouraged to position themselves in defensive positions such as those related to precious metals. Instead, the capital accumulated shifts direction toward assets that appear to benefit from higher rates or stronger growth prospects, even if the growth is somewhat unbalanced. This movement isn't necessarily dramatic enough to have a significant impact on silver prices. However, it just illustrates how market participants' short-term actions are governed by factors such as liquidity and positioning, rather than pure conviction. Recently, the significant drop observed in the market is best understood as an event that signals how markets are enforcing these real-world scenarios in real time. What investors should focus primarily on right now is understanding what this particular move does change and what it does not. A 3.5% drop might appear to be quite dramatic and significant on its own, but when placed in the context of silver's historically high volatility, it is not uncommon at all, especially during instances where financial conditions are getting tighter. Silver has a propensity to experience sharp declines even within higher-term uptrends, frequently serving as a powerful pressure valve meant to alleviate broader macroeconomic stress. What's crucial to grasp is whether this downturn is propelled by a period of stabilization or a possible acceleration towards new heights. If rates continue to rise, the silver market might remain under certain pressure as investors examine how far the financial tightening can persist without seriously threatening economic growth. However, if rates eventually maintain some level of stability, or if economic data starts to show some meaningful signs of softening, silver's inherent sensitivity can rapidly flip from being a significant headwind to a potent tailwind. This is precisely why silver is frequently described as a EA1 late cycle. It has a tendency to struggle during restrictive monetary policies, only to quickly reprice and rebound once conditions shift favorably. Another significant factor that should be taken into account is the ongoing physical and industrial demand from manufacturers and long-term buyers, which is not typically extinguished during decrease in prices. Lower prices may actually create a boost in demand from manufacturers and long-term purchasers, fostering a solid foundation that could potentially limit downside over the longer term. Markets are far from moving in a straight line most times, and silver's most important function is to take on the challenges brought on by macroeconomic uncertainty, not to eliminate it completely. The current decline is pushing a more critical reassessment of the right time to invest rather than a reevaluation of the relevance of silver. Investors who comprehend the difference between these two concepts are much less likely to get overly excited about short-term market deviations and much more likely to pay attention to the vital signals they can expect next: the emerging real yield trends, the direction of the dollar, and the status of liquidity conditions. The main message from silver's sudden drop is that markets are exhibiting a renewed sense of discipline in a high-interest environment. When financial conditions become tighter, even assets with well-established long-term narratives face challenges. Silver's decline is a reflection of the market's ongoing priority for yield, currency strength, and liquidity over preserving protection and optionality. This doesn't necessarily imply that silver has lost its presence in the financial system. Rather, it just means that the focus has shifted towards being more mindful when it comes to timing rather than having strong, unwavering conviction. For investors, this current moment is more about being proactive rather than simply reacting to silver's price movements. Instead, they're encouraged to closely monitor the various factors that drive it. If actual real yields continue to increase and the dollar continues to remain strong, there is a chance that the pressure from these forces could persist. However, if those elements reach a peak or begin to reverse, silver's potential response could be swift. History shows that silver is not typically moved quietly when significant changes occur. It's also noteworthy that the same sensitivity that causes dramatic declines also serves as a powerful catalyst for remarkable recoveries once the broader backdrop changes. For example, if real yields continue to rise and, along with that, the dollar remains robust, the possibility of persistent pressure can be expected. Nonetheless, this isn't to say that the silver market's reaction will be without notice. Markets are sending a clear signal about caution rather than abandoning their commitment. Moreover, currently in a world driven largely by debt, potential inflation risks, and policymaking uncertainty, silver remains quite relevant, even when the price action might remind investors that its importance is not linked to being completely immune to change.